Okay, continuing on with CP2. Now I've got placed up here a balance sheet template. I've added in some totals here to make things a little bit more clear. We're going to use this to complete requirement 4. Requirement 4 asks us to create a classified balance sheet. Notice the classified balance sheet is split into current and long-term, both on the assets and the liability side. Know that the breaking or the distinction point between current and long-term is 1 year. For our purposes of our discussion right now, it's 1 year. The technical definition is 1 year or an operating cycle, whichever is longer. But for our purposes here, you can think of it as 1 year. So let's have the template here. We're going to use both our journal entries and our T accounts to help calculate what should be in this balance sheet. Notice first the header. We've got APC, which is the name of the company here. I've abbreviated by the first letters of them. And then we've got the type of financial statement, a balance sheet, and then notice that as of date or at a certain date. That indicates that a balance sheet is a snapshot. It is a point in time, whereas an income statement is through a period. Okay, so starting over here, we've got assets. Assets are split into current assets and non-current assets. Let's walk over to our T accounts and determine which of these are current assets. Cash, we know cash is a current asset. It's going to be used within 1 year. So we'll put over here 105. Next, supplies. Supplies are considered a current asset. We'll put that over here. Okay, supplies we're at 15. And we've got our total here at 120 for total current assets. Next are non-current assets, abbreviated NCA over here. Let's again walk over to our T accounts. We have equipment. Equipment is a non-current asset. Why? Because its resources are for longer than 1 year period. We're going to keep using that equipment in the foreseeable future here. Usually we'll have a useful life associated with it. For instance, 5 years, 10 years, 15 years. And we'll talk about what a useful life is, how we determine that, etc., when we get to chapter 9. But for right now, we'll list out equipment here under the non-current assets, and equipment is at 118. All right, next, walk over to T accounts, figure out what we have here. Building. Building is a non-current asset. Okay, and the building is at 341. Notice how these T accounts are facilitating our preparation of financial statements. We don't have to go over to each individual journal entry and start adding up the totals and say, well, how much do we have in the cash account? How much do we have in the supply account? We've already done that preparation work via the T account, so we use these totals to help facilitate what's going to be on the financial statements, okay? Actually, you'll find out later on in chapters, we actually use the T accounts to help facilitate trial balances, and then trial balances are used to facilitate the financial statements. But we haven't got that far yet, so I don't want to jump ahead. The next T account we have here is land. Land is considered a non-current asset, so we'll put land over here. And land was listed at 90. So we'll list 90 out here. If we sum these up, they should give us the 549. And then we take the 120 right here and the 549 over here, sum those two up, and we get 669 or 669,000 for the total in the assets. Notice we have a double underline, and you do need to write that subtotal total, or that grand total assets. It will be part of your requirement when you create a balance sheet. Notice also that the header is part of your requirement when you create a balance sheet. Don't just do that on the test and give me just numbers and accounts. I want it in this format. I want with the header, okay? I want it split between current and non-current. Non-current, if you split things into current, then by nature everything else is going to be non-current. So what's important is that you split things into current, and then you have a total here for the total assets, and then that you have the header as well. And then that's for the asset side, and then we'll talk about what's important on the liability side over here. So liabilities, we split into current and non-current here. If we go over to our next T account, we see accounts payable. As we've talked about in previous problems, accounts payable is a current liability. So we will write accounts payable here, and we'll write 14. And that gives us our total and our current liabilities. Next is non-current liabilities. We'll list out notes payable. Notes payable, bottom here right. We see 147 as our total, so I've already listed out here. One thing that I want to note with notes payable, why are we putting this in non-current, you might be asking yourself. There was two transactions that we had in notes payable. We had for transaction B and transaction C. Let's look at each of those transactions. If we go back to the information given to us in the problem, it says B, we borrowed $30,000 cash from a local bank payable on June 30th, 2015. Well, June 30th, 2015 is longer than 1 year, right? Because we're making financial statements for 2013. So 2015 is longer than a year, so it's considered long term. The next transaction that we had affected was for transaction C, and it said we bought a building for $141,000, paid cash, and signed a 3-year note for the balance. So again, longer than 1 year. So the notes payable is listed as a long-term liability. The next ones that we have here are for stockholders' equity. We have the T accounts listed over here. Contributed capital, retained earnings, those are our 2 ports for stockholders' equity. So we'll list that out. Contributed capital is 508 and retained earnings right now is 0. You'll find out later that that will change once we get into more of a discussion on the income statement. You learned in chapter 1 that the retained earning balance is the beginning balance of retained earnings plus net income minus dividends and gives you the ending balance in retained earnings. But since we haven't dealt with the income statement now, we can leave this as 0 and just leave it for a subsequent discussion in chapter 3 and beyond. When we add these up, the total liabilities plus the total stockholders' equity here, we get total liabilities and stockholders' equity. Notice that this $669,000 agrees to this $669,000. Our balance sheet is in balance, and that's important. If it is not in balance, you know that you've made an error, okay? Let's go on to the last requirement here with this problem. It says, as of July 31st, 2013, has the financing for APC's investments and assets primarily come from liabilities or stockholders' equity? Well, it's real simple. We just look at our balance sheet and say which one has the higher balance, liabilities or stockholders' equity. In this instance, stockholders' equity from contributed capital has a much higher balance than liabilities. So our financing, our assets, how we financed our assets, the majority came from stockholders' equity. If you have any questions on this problem, please feel free to email me or contact me in another way. I've given you my phone number as well. I know this problem was a lot of information thrown at you, so feel free to rewind the video, replay it as many times as you want, and of course always contact me if you have any questions. Thanks.